Hello, in this lecture we're going to talk about partnership net income allocation to the capital accounts. We will be able to list the closing process for a partnership, allocate net income to partners with partnership agreement that includes salary allocation and interest on initial capital investment, create closing journal entries for the partnership, and explain the effect of closing entries on the trial balance accounts. All right, so we're going to talk about the partnerships fairly quickly. I want to give a quick outline of the different types of agreements that could be made with the partnership, and then we'll go through the closing process and the allocation. So in this case, we're going to be allocating this net income. So this net income down here is calculated as revenue of the 150 minus the expenses here. Note that on our trial balance, we have assets, which are going to be the green accounts, and then we're going to be focusing in here on the capital accounts for our partners, C, X, and S. So we have the capital account and the withdrawals for each partner. Then we've got the income statement portion. We've got the sales minus the expenses. We are representing the debits with positive or non-bracketed numbers, the credits with bracketed numbers. Now, the main issue that partnerships are going to have to deal with is how to allocate the net income to the capital accounts. So remember, the capital accounts kind of represent what the company or the partnership owes to the owners, and therefore this net income needs to be allocated to the capital accounts in some format. Now, the partnership agreement is more flexible than any other type of agreement or any other type of forming of a business, and you can have a lot of different ways to allocate the net income. Most students, when you ask what the allocation should be, they say, well, if there's two partners, it should be 50-50, right? It should be an even allocation. Most students will say that will be the simplest type of allocation, and that's often used. And even if it's not a 50-50, it could be, 60-40 or something like that. Some kind of just simple allocation in terms of a ratio or a percent is a very easy way to allocate. And that is going to be very common, a lot just because it is an easy form of allocation. But also want to mention that many forms of partnerships are not going to be symmetrical, meaning the two partners may not be putting in the same resources in terms of skill and capital. And that's probably a good thing most of the time, because when we form organizations, we want to have people that have different skill sets and different types of resources. So many times it's not going to be symmetrical. And I kind of compare this a lot of times to if we're two roommates that were going to be moving into a new place, and the new place had two bedrooms, but the one bedroom was twice as big as the other bedroom or something like that. There's going to be a non-symmetrical system in that, and you're going to have to decide, well, how are we going to deal with that? Well, obviously the obvious choice is that, well, the person that takes the larger room, we can have the agreement, the partnership agreement between us be that they pay more of the rent. That would be an obviously way to deal with that. Or we could have any other number of agreements. We could say, well, the person who gets the larger room has to do more chores or do more cooking, or they have to handle the utility bills and whatnot, and deal with it in that way. Also note that as time passes, the partnership agreement can be revisited and looked at a different time, and that can be done with this type of partnership agreement as well. So in terms of a business partnership, it's going to be very common that one person perhaps has more capital to invest, where the other person has more time to invest. And so let's take that example as our first example and say, what are some ways that we might be able to deal with that? What are some common kind of textbooks ways that we can form a partnership agreement to deal with a situation where one person is going to put in more capital and the other person is going to put in more time? On one sense, it is symmetrical. You could say, well, one person's putting in money and the other's putting in time. That's even. However, I mean, if you look at it in terms of the timing of when people put stuff in, the person that puts the money in is really putting a lot on the line at that time, at the beginning. So they're at risk right at the start of the business. Whereas the person who puts in the time hasn't put in any time until time passes, until they start doing work. So in that sense, the risk is going to change over time. When you first start the partnership, the people that are putting in more capital are putting more at risk at the beginning, and then toward the end, the people that are putting in more time are taking more risk. So one thing you could do is you can have, well, one agreement at the beginning. You could say, well, we'll have a profit split that will guarantee more towards the people putting in money at the beginning, and we could revisit the agreement later. Or you could come up with something like, well, we will take into account your capital investment and we'll give you a basically 10% of net income allocation before we allocate the rest, in this case evenly. So that's one way, that's a common way. Why would you have a 10% allocation of investment? Well, we're going to try maybe to give a return on investment, a guaranteed return on investment to the individuals that have invested more, and therefore hopefully generate people to invest in our business so that we can grow. That would be one type of allocation. Another benefit to that type of allocation is that partners that have a lesser capital account balance, who have contributed less, possibly could contribute more over time, and thereby even out the capital account without having to renegotiate the agreement. It could even itself out in that way. So that's the first one way that we'll take a look at this allocation. We're going to allocate 10% of the beginning capital accounts. Now, if we think about the beginning capital accounts, remember the accounting equation is assets equal liabilities plus equity, or you can think of it as assets minus liabilities equals equity. The equity accounts here are the book value of the company, and the book value is owed to the owner, which are these three owners. So what we need to do then is track these capital accounts and make sure that they represent the amount that is owed to the owners. Note that if we look at a particular capital account like C's capital, X capital on a trial balance, before we close out net income, such as in this case, the sales and the expenses, that capital account is really the capital account as of the beginning of the period. So that if this was a year, it would be as of the beginning of the year or as of the beginning of the month, unless the company invested more into the company. So note that we're going to basically take this as the beginning capital account. That's the beginning capital account before we close out the income statement to the capital accounts. So this number is what we're going to multiply times the 10% as the investment and allocate a portion of this $80,000 in that fashion. The other type of way that we could have an allocation method in a partnership would be to have a salary allowance. Now, a salary allowance does not have anything to do with payroll, meaning we're not going to withhold federal income tax or FICA and whatnot on it when we talk about a salary allowance when we are allocating for a partnership. The reason we call it a salary allowance is just because it's going to be like a fixed number, just like if you had a salary. We just came up with a fixed number that we are going to allocate out. Why would companies normally do this, or why would a partnership come up with a salary allowance? That could be a scenario where, certain individuals are going to decide to work a certain amount of hours, and we're going to try to allocate to these individuals based on the amount of work. So that's going to be just in a problem. The book's just going to say, here are the salary numbers. They're just going to give you the flat out numbers on those. Then after that, we're going to allocate the difference evenly between the three partners. So we'll take whatever the difference is, divide it by 3. So let's first go through the closing process. And this is a process that's skipped by a lot of books, and it kind of leaves a gap in terms of people kind of get confused on how the closing process fits in when they do this allocation method. So remember, in the closing process for a partnership, just like any other company, we are going to close out sales to the income summary. Then we're going to close out the expenses to the income summary. Then we're going to close out the income summary to the capital accounts, which is the difficult part now because we have multiple capital accounts. That's going to be where this allocation comes into play. And then we'll close out the draws to the capital accounts, which is the same as anything else, except now we have 3 draws accounts because we have 3 partners. All right, so the first one, we're going to close out sales to the income summary. Nothing new here. If we have sales here, we have the 150. We need to make it go down, so we're going to do the opposite thing to it. It's a credit, therefore we're going to debit it. So we debit sales by the 150, bringing it down to 0, which is what we want. Then we're going to put it into that clearing account, the income summary account. So here's the income summary. We're going to put it into the income summary. Now we have a 0 in sales, and we have the income summary has the income of the 150 in it. Then we're going to do the same thing for the expenses. I'm only showing 2 expenses here, so it's a pretty basic income statement, but this is the idea of it. So we got to close out these expenses. How are we going to do that? Well, these are debit balances. We're going to do the opposite thing to it. We're going to credit them to make them go down. So we're going to credit this expense by the 60. We credit this expense by the 10, bringing it down to 0. And then the 60 and the 10 add up to 70. That's going to go into the income summary. So you'll note what is in the income summary is net income, the $80,000 at this time. Now, this is important to note because many textbooks will actually just kind of shorten this problem up, and they'll just start here. They won't even give you the trial balance or anything. They'll just start at the 80,000 and say 80,000 is in income summary before the income summary is closed out to the capital accounts. And you just kind of need to know that, well, this is where we're at in the process. We closed out the income statement to the income summary, and now we're taking that, which is net income now, and deciding how to allocate that to the capital accounts. So that is where we are at this point in time. So now we need to think about the worksheet. And this is the problem. We need to close this out, but we need to know how to close it out to these three different partners. So now we've got this 80,000, which is net income in the income summary, and we need to go through this worksheet, which will be allocating in accordance to the partnership agreement over here on the left-hand side. So here's the net income that is coming from the income summary. We're going to allocate that out between C, X, and S, the three partners, in accordance with this agreement over here. So the first thing we're going to do is we're just going to take the salary allowance. So we're just taking the salary allowance and plugging it in, and it's pretty basic here. We're just going to take the exact numbers that they give us and plug those in. We just came up with those numbers in terms of the agreement. Just remember that the salary allowance has nothing to do with payroll. We're not going to pay payroll taxes on it. It's just a set number that's kind of like a salary in that it's a fixed number and proportion. If we add the 4, the 3, the 8, 15 is what it adds up to. We have 80,000 of net income, therefore 80,000 minus the 15 means that we still have 65,000 left over that we will need to allocate to the three partners being C, X, and S. The next one we're going to do is we're going to allocate based on 10% of the capital account. So if we do that, then we look at the capital account on, in this case, the trial balance. So remember, the trial balance has the capital account here. This is not the ending capital account. It's really the beginning capital account because we have not yet closed out the income summary to the capital accounts. So this is what was in the capital account at the beginning of the time period. And we're going to take that 144 times 10%, which will give us the 14.4. So we are going to allocate of this 80,000, 14.4 to C based on the 10% of their capital contribution. Then if we take a look at X, they had 216. Therefore, we're going to take 10% of that and allocate 21.6 to X of the 80,000 based on this capital contribution. And then S had 120. So 120 times 10% gives us 12,000. Therefore, we're going to allocate 12,000 to S. So if we add that up, 14.4 plus 21.6 plus 12 gives us the 48. So remember, of this 80,000, we allocated 15 here. We were left with the 65. Now we allocated 48 based on this allocation. Now we are left with 17 left over still, which we are going to allocate evenly in accordance with our agreement here. Note that in this agreement, it happens to be even. Does not have to be. We could have picked any kind of percentage allocation or ratio allocation. So if we just take that 17,000 divided by 3, then it would be 5,667 to each partner. That adds up to the 17, and therefore that ties out, right? So if we add these up now, C got 4,000 from the salary, got 14.4 from the capital, and then an even allocation for the rest of 5,667. So we are going to give 24.67 to C. X got 3,000 from the salary, got 21.6 from the capital, got 5,667 from the even allocation of the rest, gives us that 3,267, and then S got the 8,000 from the salary, 12 from the interest, and the 5,667 from the even allocation, and of course the 24.67 plus the 30,267 plus the 25,667 adds up to that 80,000. So this 80,000 will be allocated in this format. Now, the thing I want to point out here is that you may have noticed that what if we came up to an agreement where, and we didn't earn 80,000? I mean, what if this was something less than 80,000, and then when we subtracted out the 15 and the 48, we could possibly have come up with a negative number. I mean, what if we only earned 20,000 of net income, and we said we're going to allocate a salary allowance of 15 and then an interest allowance of 48? That could very well happen. And if there's nothing that is stating that what should be done in the partnership agreement under that scenario, then under this agreement, we would then take that negative number and allocate it out evenly. We would have to reduce the capital accounts evenly. And that's something that should be addressed when thinking about the capital accounts, because that could have a significant effect and could be a strange happening, or something that would be unexpected to partners. So now in this case, we're going to allocate out in this format. So we're going to then take this income summary, we're going to debit it to make it go down, and then we're going to credit the capital accounts, increasing them by these amounts here. So let's take a look at what that would look like then. We have the income summary is now going to go down to 0. That's the normal process in the third step of the 4-step closing process. And now we're going to allocate to the capital accounts in accordance with the worksheet we just took a look at. So we're going to say that the C's capital account is going to be credited, making it go up. It's a credit balance, and it's going to go up by the 2467 to the 168.67. So remember, this represents the amount that is owed kind of to the owner in that sense. So in that sense, it's similar kind of to a liability, right? Because if we think of the company as different or separate from the owners, then the company owes something to liabilities. They don't owe any in this case, but liabilities are something that the company owes to, and the capital accounts represent something that the company owes to, in this case, owes to the owner. So and so we're going to credit the X capital account here. So it went from 216 up in the credit direction to 246 to 67. Then we're going to credit S's capital account. So S is going to go from 120 credit up in the credit direction, because we're doing the same thing to it, by the 25,666 to the 145,666. And now we need to just do the last process, which is to take the draws and close them out to the capital account. So this is the same as our normal closing process, except now, of course, we have 3 partners with 3 different draws. One thing I want to point out with draws is that the draws are not going to necessarily match, say, like the profit sharing method here. So there's nothing, unless there's something in the agreement saying that would limit the amount of draws that a partner could take out. So that the draws will not kind of have a rhyme or reason in accordance with this agreement. So the draws could be completely different, and that will also throw off the capital balances. So many people often think that the capital balances should be in alignment with basically the profit sharing agreement. Remember that the profit sharing agreement only has to do with the allocation of income and losses. It does not mean that the ratio of the capital accounts will match the profit sharing there, because the draws will basically throw it off. In this case, we'll have more than the draws will throw it off. All this will throw it off. But even if we just had an even allocation, the draws would throw off the capital accounts to not match the income allocation ratio. All right, so here's what that journal entry would look like. We would have to take the draws. The capital account is going to be decreased by the draws, and we're going to make the draws go down to 0 for C. So if we think about that, we say, well, C had a debit in draws. We need to make that go down, so we're going to do the opposite thing to it. We're going to credit it, and then we're going to debit the capital account, reducing it. So if we post that out, then the draws are going to go to 0, and the capital account is going to go down by that 18, because just like if it was a liability, the company owes money to C. C took out that money, and therefore it's going to reduce the credit balance down. So if we did the same thing for X, we're going to say X has 38,000 in draws. We need to make it go to 0 to close it out. Therefore, we're going to do the opposite thing to it, which is so we're going to credit the 38,000 here, and then the debit's going to go to the capital account. So here's the capital account related to it, and there's the debit, which will bring down the capital account. It has a credit balance. We're doing the opposite thing to it to make it go down. If we take a look at S, then we're closing out the draws. We need to make draws go to 0. It's at 24,000, has a debit in it. Therefore, we're going to do the opposite thing to it, which would be a credit. So here's the credit. We're going to credit the draws, the withdrawals, and therefore we're going to debit the capital account. So here's the capital account, and here's the debit. We're going to debit the capital account, making the credit balance go down by doing the opposite thing to it. And now you can see that we just have the capital accounts here. So everything else is going to be 0 below the capital accounts. There's no income statement accounts. The income summary will be cleared out, and all withdrawals will be 0. Also note that if we take a look at the post-closing trial balance, then assets minus the liabilities, there are no liabilities in this case, are going to equal the equity. So the equity is the book value. The equity is what is owed to the partners in this case. And in theory, the equity means that if we sold the assets and paid off any liabilities, then the equity is what would be left over. So we are now able to list closing process for a partnership, allocate net income to partners with partnership agreement that includes salary allocation, interest on initial capital investment, and create closing journal entries for partnership, as well as explain the effect of closing entries on the trial balance accounts.